Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins Hutton. We do this show live every Tuesday to help you learn the ins and outs of passive investing so you can go into your first or next deal with confidence. So be sure to check out passiveinvestingwithwhitney.com for future masterclass sessions, also our boot camps. We've got another boot camp coming up here the second Wednesday in November, so I'm super excited. So make sure to check that all out. Right now, we are waiting on our guest of honor today. We have Jim Oliver joining us from Create Tailwind Community. He actually just has a book coming out called Make Bank Without the Bank. It's coming out soon. I just had the opportunity to read the first few chapters. But while we are waiting for our guests to join, I'm going to just make sure they're not in the participants box. Sometimes it gets a little wieldy to get people on Zoom sometimes. So apologize for that. We are tracking him down as we speak. But I would love for you to go to your Q&A box and drop in where are you joining from. So, I want you, that'll help me understand who our audience is here today, but also like where you're joining from. And it'll help for those of you who this is your first time, understand where the Q&A box is. That's where all of our questions will go. And then I also want you to drop in what are your burning questions that you have regarding how to use cash flow life insurance, or what we call IBC, infinite banking concept, in order to grow your wealth. Maybe not just shield it, but also grow your wealth. Let's see, we got people joining from Washington, Bowling Green, Kentucky. Awesome. I know there's so many more of you here on this webinar. You guys, go to your Q&A box. I would love to know where you're joining from, but also put in your questions, because this isn't the first time we've covered the infinite banking concept, here on the Passive Investing Made Simple show. So I want to make sure that we are, thank you, we got a Montana, thank you, Ryan, Capital District of New York. Ooh, love it, love it. Thank you, guys. I would love to know what your specific questions are, because, there's investing or opening up an insurance policy, and then there's actually leveraging it as a tool to grow your wealth. And so there's a couple of different ways that we can use this opportunity. All right, I'm just double checking our list. All right, so you know what? I want to honor everybody that's here already, that's here on time. We are going to go ahead and get started. If Jim and Nick join us in the middle, we will get everybody connected together, and we'll just go ahead and launch into our podcast. But since you guys are here, you are blessing me with your time, you're investing in yourself, I want to go ahead and start kind of tackling part of this concept. Now, guys, remember, I am not an insurance provider. This is not what I do. This is why I bring the experts on. But every once in a while, coordination with Zoom just does not happen. So we're going to go ahead and just tackle these questions. Now, I came with some of my own questions, and I actually came prepared with some answers. So give me a second. I'm going to get that all pulled up for you guys. But you guys, thank you. There is, you guys are dropping your questions in the Q&A box. We'll just make this a little Q&A session until, hopefully Jim and Nick will join us. Okay. So let's first understand what infinite banking is. Okay, so most people, when they start, and this is where I always start my conversation, what it is, why it's important, then like how to do it. Okay, so infinite banking is really how can you leverage a whole life insurance policy, but not for the death benefit. Okay. And that's how most of us have been trained as retail investors. Get the most death benefit you possibly can for the least amount of premium. That is not what you're trying to do here with an infinite banking type policy. Okay. And it differs from term insurance. So I had the opportunity to read Jim's book a little bit, and he has a great analogy, and I believe it's actually taken from Robert Nash, who's kind of the guru in the space. It's been around for over 50 years. Think of a term life insurance policy as renting a house. Okay. But think of a whole life insurance policy as buying the house. Right. So essentially, one is kind of more of an asset versus one being just like you're kind of renting the policy. The terms can always change on you. Maybe you only have a term life and policy for like 20, 25, 30 years. You lock in a rate really low, but you don't really have any other benefit to leveraging that policy other than just getting a death benefit at them. Okay, it can be pretty low expensive. Now, for me, how I work with my direct coaching clients, I actually, if they're just starting out, maybe a term policy, is for them, right? Because we've got a lot of other things to tackle in what I call their financial moat. Getting like their emergency account set up, starting to actually physically save, maybe understanding what is the best use of how to leverage different types of like house savings accounts, flex spending accounts, even retirement accounts. Okay, but once you kind of got all of those things in place and you start getting some assets under your belt and you've got cash flow coming in, now we're starting to speak a different language. You got a different game that you can play here. And that's where a whole life policy, and again, I'm not an insurance agent, but this is just my experience with coaching. This is we start looking at these tools as a way to build your own bank. Okay, now again, this is not the type of policy you walk down the street and go to State Farm and or talk to your uncle about or your cousin about who might be in the insurance world. This is not that type of policy. Again, it's not a retail policy. We're not trying to buy the most life insurance death benefit for the least amount of money. Okay, we're not going to have that retail thinking. We're going to have a very different approach to this, which is how can we set up a policy and stuff as much cash into it as possible. Therefore, we have what we call cash value building up in that policy that we can now, we now own the policy. We're owner of the policy. Okay, we are the beneficiary of the policy, or our family, should they pass away. And then also we can be the borrower of the policy. Okay, now this is how it becomes a bank. Right? Because if you think of how a bank is organized, you have your owner of the bank, you have your depositors in the bank, and then you have the borrowers that borrow money from the bank, right? So when we talk about how you use the whole life policy to create your own banking system, essentially you're putting yourself in the position where you can be the owner, the depositor, as well as the borrower. Now, here's the cool thing. When you set up a kind of a personal banking system like that, and like my husband and I, we have a couple of these policies ourselves, you can borrow, take a loan against that cash value, and the life insurance company will put a lien against your cash. You're actually taking the loan from the life insurance and company's coffers, and they put a lien against your cash value. All right. They don't care whether you pay back the loan or not. Okay, they would love it if you paid the interest on the loan, and sure, maybe they would love it if you paid back the loan, but they don't care because they've got it. They have the cash value built up in there, and they put a lien against that. Now, this is where it becomes really truly your own banking system, is because now all your cash value in that life insurance policy is continuing to compound at a certain rate. Whereas the loan you take from the insurance company is simple interest. Okay, so now we create what we call arbitrage in here. And I wish, I'm going to double check again, see if we got Jim and Nick on here. I'm going to continue to check my inbox and see if we can pull them into this conversation. Awesome. Hold on. Jim is super close. He needs me to send the link again. Again, the wonders of Zoom, where we've all been trained. So every once in a while, it just doesn't work for us. Okay, hold on. Let me get Jim in here real fast. And thank you guys for hanging with me. Oh, sorry, Tim, I didn't mean to do that. Okay. There we go. Okay, so anyways, that's kind of like the overarching way that like the life insurance works. That's what it is. Okay. You're getting a type of insurance policy that you're not renting like term insurance. You're buying it more like a house. And then we're trying to put ourselves in the banking position. Okay. We're not going to make deposits at, say, like at Ally Bank. Okay. Where the bank owner, is doing one thing, you're the depositor, and then they're lending out the money and making an arbitrage on their end. You're putting yourself in all three of those positions. All right, let's see. Anyways, okay. So once we do that, again, I'm still working in the background. Jim's in my inbox, blowing it up. We're trying to get him in here. Once we do that, now we need to understand why we want to do that. Okay. Again, I kind of touched on that a little bit as far as like you're building your own bank, you're putting yourself in all 3 points of that triangle. But now you're also putting yourself in a position to where you can borrow money and from the life insurance policy. And these policies are built in such a way that they're guaranteed loan. Okay. You don't have to go to them and tell them, well, I'm buying a house. You don't have to tell them why you're borrowing the money. You don't have to qualify for the loan anymore because you're already qualified with, with opening up the policy, creating the policy at the very beginning. They've already underwritten you. Okay. And so, and they are only going to loan you, what you have available in your cash surrender value. And they're probably, say like you have $200,000 in your cash surrender value. They maybe only give you like 85 or 90% max of that. They're going to leave themselves some cushion there. Okay. Or put a lien against that. Okay. But you put yourself in a position now to be able to leverage this triangle. Okay. You're also, you're going to be able to create arbitrage with that. Remember, you're borrowing at simple interest. Right now, for my policy, the simple interest rate is 5.7%. Who here wouldn't be ecstatic to have an interest rate on their loan of 5.7%? Okay, so instead of me going to the bank and borrowing at 8, 9, 10%, or whatever that rate is, I can now borrow it against my own life insurance policy at 5.7%. And remember, they've taken the lien against my cash surrender value. They don't care if I pay that back or not, because if I kick it, they're going to go ahead and like surrender that they're going to pay out the value. Jim's here. I'm going to just finish my thought, Jim, real fast. They're going to go ahead and take a look at what you have in your cash surrender value. They're going to like pay themselves any liens off first on, or that they put against that cash surrender value, and then they give the rest to your beneficiaries. Jim, I was killing time and I was crushing.
I'm so sorry. I didn't. Yeah, I'm sorry. It was my mess up. Technology and me some days just do not see eye to eye. I'm so sorry for being late.
Yeah. Well, Jim, we got about a half an hour and we've got tons of questions queued up in the bank or in the Q&A box. I think where I want to take this right now, just so we can get a clean podcast recording, is we'll just do a quick recap of like what it is. We already went through like the analogy that you have in your book, but I love that analogy. And then we'll just, go over why it's important. And then we'll start getting into the hows to do this and then clean up some of these questions. Sound good?
Sounds great. Absolutely.
Awesome. And you guys, I'm going to moderate and we're going to knock your socks off in the next 30 minutes. I'm going to moderate. So continue to put all your questions in that Q&A box. And I'm going to fire away at Jim whenever we get to that how-to section.
Absolutely.
So, all right, Jim, just recap for us really quickly who you are and how you got into the space.
Yeah, absolutely. So my name's Jim Oliver. I live in Southwest Florida, just a little north of Naples. And I got interested in financial freedom is really my message and the thing that I'm passionate about, financial independence, buying assets, not instruments, because I grew up very poor in inner city Los Angeles, and around you, just in a few miles, they're like amazing neighborhoods and amazing houses, and everybody's, in my view, I'm sure it's not perfect, but when I was a kid, it sure seemed like it was. And one of the areas was Palos Verdes. And at 13 years old, I got a job working in a casket factory in the summer, swinging a hammer and building caskets, the hardware for caskets with McIntyre Manufacturing. And Dwayne McIntyre, the guy that owned this little company that I thought, oh, that can't be making that much money, he was living in Palos Verdes. And so one day I was walking down the street by a friend's house, and the most rundown house in the neighborhood, I see this guy pulling weeds. And I look down, and it's Dwayne McIntyre. And I said, what are you doing here? He said, I own this house. And I said, but you live in Palos Verdes. And he said, yeah, but I have rental property all throughout Los Angeles. And so, I'd like to be able to tell you I was 13 years old. I figured out then at 13, you need to be a business owner and you need to own real estate. But Whitney, I wasn't that smart. It took me 20 years for that lesson that I learned at 13 to sink in, because I decided, hey, Wall Street is the place. That's how you help people make money. And I started in Wall Street as a fee-based financial planner, full service, right? That's what we would say. And one day we're analyzing our rates of return for our clients. And I realized that it wasn't 9.38% like the report said. It was really around 4%. And I thought, wait a minute, the math doesn't work at 4%, and so I looked at all of my clients, all of the ones that really had serious money, not the ones that got lucky, the ones that had serious money and they earned it, came down to two things: businesses and real estate. And it was building passive income. And they didn't have a care in the world. They were not stressed because they had more money coming in passively than their ideal lifestyle needed, right? So why would they worry? If the government keeps on printing money, they just raise their prices or raise their rent. And so I got out of Wall Street and I met Nelson Nash, kind of the godfather of becoming your own banker. And why Nelson was so passionate is he's an Austrian in his economics. So he's free market, right? And he's passionate about that. And it so happens that to be in a free market, you need to control the banking function, because there's a problem we all have and that we're trying to solve, is that we finance every single thing that we buy. We either pay interest to someone else or we give up interest we could have earned somewhere else. There are no exceptions. So if we can use other people's money, like the bank, to go make money, and then we pay ourselves interest, well, then we're acting like the bank. And it hit me like a ton of bricks. And I decided that that's what I'm going to teach people to do. I'm going to teach people about freedom, financial freedom, education freedom, medical freedom. Relationship freedom. All of that doesn't mean not to be, I believe in monogamy. It doesn't mean freedom like that. Okay. But it's having more money than you need, a great relationship, intimacy, all of that, connection, tons of money, tons of travel. I want to be free.
Awesome. And, I'm glad you touched on the banking concept, because, as I was killing time, for the show, I was trying to educate people. And I'm like, my husband and I, we have two policies ourselves. And, it's given us, a lot of freedom. I think we're still in our, definitely our accumulation phase of things, but, we don't spend things anymore. We've got cash values, there. During COVID, when nobody could get a loan, we just borrowed from ourselves. We could continue to buy rental property. We were closing properties. And I remember we really wanted to get a new camper. And, what does your lender tell you to do? Don't take out a loan. Don't make any big purchases. We were like, but we got our cash value life insurance. They don't know. So we're going to go buy that camper. Like, we're going to continue to fund our dreams. We're not going to live, I'm struggling to come up with the politically correct words here, but we weren't going to take no for an answer. We're like, we're going to make this happen. We want to take the big trips. We want to take a big trip that, end of next year, do we have to save up for it? sure, we're going to do that, but also we've got our cash value life insurance policy we can lean against to fund those type of adventures for ourselves. So I love this concept. I think what a lot of people are here to learn is they're passive real estate investors. Okay, so many of them, I'm sure, have their active properties, or they're trying to figure out how to transition from active investing to more passive investing. But why would a passive investor want to set something up like this? They're not going out and getting their own real estate necessarily, but they're evaluating operators, evaluating passive deals. And why would they consider doing something, setting up an infinite banking for themselves?
So the reason is we need to back up, Whitney, and just talk about banking. Okay. So before we think about becoming our own bank and how that we can use this insurance contract and act like our own bank for the infinite banking concept, we need to understand like just something really basic about banking. Okay. So first, one thing that every bank needs is a depositor, right? Because they're not going to use their own money. They're smarter than that. They want to use somebody else's money, right? So when I say they're smarter than that, I mean, if they can use somebody else's money, why wouldn't we? If we could leverage somebody else's money, we're going to do the same thing too, whether you're doing it passively or actively, it doesn't matter. So you have a depositor. The depositor goes down and they deposit money at the bank. And by the way, when they deposit money at the bank, is that an asset or a liability for the bank?
Wow, that's a great question. I would say it's an asset, right? It's positive on
Yeah,
the
because we've been taught to think of a deposit as an asset, but it's a liability because they have to give that money back to you anytime you want. And they got to pay you a little bit of interest, and they haven't made anything on with that money yet. But how do they turn it into an asset? They loan it to a borrower, right? The loan is the asset. Again, it's opposite. The way that the bank thinks is opposite as the consumer, right? They're the owner of the bank. The customer of the bank thinks of things opposite because the bank knows the borrower is going to pay the bank interest, and then the bank's going to pay you just a little bit, as little as they can. So let's use some numbers, some real numbers. And I'm going to use 2016 numbers. Now, people would say, well, why don't you update those numbers to 2023? I could do that, but guess what? It's cyclical. So tell me what year, and I'll pick out a number. So I just use 2016 because that's the last time I did this. Well, in 2016, and it'll show you in a low interest rate environment, the bank actually makes more money. Okay. So you put $10,000 in the bank. They were paying, this is Bank of America in 2016. So I used a big bank, 0.2% on that deposit. That's $20 over the next year. Okay. And their average interest bearing deposit, or I'm sorry, their interest income from their loans was 5.2%. Okay, so people say the consumer brain again says, hey, that's $500 more than me. That's not a big deal. They got to pay these people in the building and everything else. But Whitney, that's not how a business works. You divide your cost into your profit. $20 goes into 520 26 times. So that means they're making 26 times more than you with your money. Now, just to wrap that all up, there's only one banking system in the world. So if you have money deposited at one bank and borrowed from another bank, the banking system is making 26 times more than you with your money from you. Now, if anybody understood that this was happening, Nelson used to say, if you know what's happening, you'll know what to do. Infinite banking is building a wall around this transaction. So you're the depositor, you're the owner of the bank, and you're the borrower. Okay. Excuse me. So here's how we're going to do that is you have this insurance policy. It's designed for cash value. Yes, it has death benefit. Yes, it has illness protection. Yes, for the spouses, you'll have more death benefit on each other than you would ever go just buy, because we're going to be putting more and more money through these, especially as a passive real estate investor, through these insurance policies. Like you said, you have 2, right? Nelson had almost 50 at the end of his life. So what we're going to do, it's designed like a bank would design BOLI, bank-owned life insurance. Why would a bank own life insurance? They know what we know, right? Why would the FDIC say you could only have 25% of your tier 1 assets, your best assets, in life insurance? because they also know once it's in there, it's never taxed again. Okay. So we design it like a bank does. Now we buy it from a mutual insurance company. And the reason is mutual insurance companies are owned by policy owners, not shareholders. Okay. So we're going to own part of the policy or the company. As an owner, I have a contractual right to take an interest-only loan anytime I want, for any reason I want, interest only, okay, up to 100% of my cash value. Now, here's where people get confused, insurance agents especially, is when you take that loan, your money doesn't leave that account. You're using the insurance company's money to now go invest in real estate. You don't have to tell them what it's for. You don't even have to pay it back. You just, at the end of the year, have to pay the interest. Or you don't. Your tenants do. Your investment does. Your assets do. Okay, so I take this loan. They put a lien on my cash value. And yes, if they die, then that loan comes off of the death benefit. And the rest of the tax-free money, tax invisible, goes to their family or their heirs. But I'm going to now remember, I got the insurance company's money. I have OPM. I have use and control of it, which is what a bank wants. I'm going to go buy assets. I'm going to go work with an operator to get passive assets or whatever you want to do. You could buy, if you're a dentist, you could buy operatories. Instead of leasing them, buy those and lease it back to yourself, right? Personally, right? As that money flows back in, we're going to redeploy it and redeploy it and redeploy it. Pretty soon, we don't have to put any money in the policy. Our tenants, our investments are putting all of the money that we need to in the policy. So guess what we need? We need another bank, right? We need more and more and more banks, because if you owned a bank, you'd want it to be a big one, right? Does that help?
I think it does. I think it really does. I think, for me personally, and this is something, maybe some other people that are listening in right now have this kind of question is like, we have a policy on me, we have a policy on my husband, but my husband, you guys stop me, go to the chat box and stop me. But I'm going to use this time too to ask my question. I'm trying to get him to the point where we get another bank. And he was like, why would we do that when we have the cash coming in to grow and go get the next asset? Like, why would we run it through another policy and take on that premium?
So the reason is, okay, in the beginning of the insurance contract, the first year you put in $1, you don't have all of your dollar to go put into real estate. But by the 10th year, you put in $1, you have $1.50 to go put into in real estate. And every year after that, you have more and more and more and more. Now, it doesn't take till the 10th year to have more. It takes, with no infinite banking, around the 4th year. You put in $1, and from that deposit, you have more than $1 to go put into real estate. So now we're leveraging, right? So that's the reason. Because tell your husband, we're the owner of the bank, not the customer. The customer never has to make an investment. The owner has to make an investment. That's the beginning of the policy. But after the first year, and if you're doing infinite banking, in that second year, and you're flowing the money back into the policy from what you made off of the investment, you'll have more than the $1 that you put in. So if I put in $1, I have $1.05. I put in $1, I have $1.10. Put in $1, I have $1.20. Pretty soon I'll put in $1 and have $2. So now, like, if that's the ratio, Whitney, you write me a check for $1, I write you one for $2. How big do you want that first check to be if I'll let you write it for whatever you want?
Oh, I'll play that slot machine all day long.
Right. So you would write a check for $10 million if I would turn around and write you one for 20 million, right? Mm-hmm. So that's what you tell your husband, is we need a bigger bank, because once this starts leveraging, we want more volume leveraging, and we're not so concerned with rate.
Got it. Now, I would love to dive in to some of the user questions here in a minute, but like, how does somebody set something like this up?
So the way I look at it is kind of like this, is you got to educate yourself about it, right? And we have a community that has free courses that explain Nelson's book. You know, I want to make an offer to everybody that's on this webinar. If you send me your physical mailing address, or if you just join the community and then inside the community message me, and I'll send you your choice, either my book, Make Bank Without the Bank, or Nelson's book, Becoming Your Own Banker, Unlocking the Infinite Banking Concept. Okay. Either book, both books are under 100 pages. You'll read them in less than 2 hours, and they're straight to the point. But if I were going to go climb Mount Everest today, yes, I would make sure that I had the right jacket and the right boots and the right gear. But I'm going to hire the best Sherpa I can find. Somebody that's been up that mountain a lot of times, right? And you know what? If you go to createtailwind.com or go to the and join the community, see if you want to talk to us, but we can set that up for you, and we can help you set up the insurance policies. We coach you forever on how to use the insurance policies, but you have to find a guide, and you have, like you said earlier, somebody to partner with that you know, like, and trust, and that has experience and can help you climb that mountain.
Awesome. Well, let's dive into some of the questions.
Awesome.
Because one of the first questions that I wanted to ask is, is there a benefit to infinite banking if you usually roll your disposition returns back into a new syndication style deal? Like, so the way I kind of see that if somebody has they're trying to weigh, I've got a, piece of real estate, or their ownership in a piece of a real estate selling. Like, wouldn't I just roll it into the next deal versus taking it out, putting it through a policy, and then putting it into the next deal? Like, what would the pros and cons be of those two strategies?
So the way that you look at the policy, don't look at it as an investment, because it's like a money pool. It's just like the bank. Okay. So if you have another deal, then yeah, roll it into another deal. If you don't have it, then don't hold it in somebody else's bank and let them go make money with it. Put it in your banking system. So when you have those windfalls, you can flow it back into the policy. You can pay premiums with it. And again, remember, do I want to pay premiums if I put in $1 and I have more than $1 to go use? Absolutely. You could pay back loans. You're in control. You're the bank. And so another way to think about this, and this might help answer this question, is if I would loan you $100 million today, and your only obligation was to pay me $5 million of interest 1 year from today, would you take the loan?
I mean, as long as I had assets yeah, I would try to figure it out.
Because what you're going to do is you're going to go take that money and you're going to go invest it and make 10, 12, whatever percent or more. And then at the end of the year, and that money is going to cash flow, that money is going to flow back into the policy, which means I'm not going to pay 5% on it because I'm only paying on the outstanding loan. But like, let's say that I took it and I'm going to go leverage that money and I'm going to use that as a 20% down payment. And I'm going to go get 80% loan to value from the seller or the bank. And the reason I say 80% is I got to pick some number. Okay. So don't beat up my numbers. It's just an example. And I'm going to get 25% cash on cash after debt load. My super experienced real estate people tell me that 25% is too low. Newer people tell me it's too high. I'm just using a number. Okay. It makes the math easy. So I'm going to make $25 million on that loan, or on that real estate, that $500 million of real estate. So I'm going to call you up and I'm going to say, hey, Whitney, I got your interest check, got your $5 million check. I'd like to fly up and deliver it to you, take you and your husband to dinner. We go to dinner. I hand you your check and you say, Jim, do you want to pay me principal? And I say, nope, see you next year. That's the kind of loan that you have. And that's the kind of power that you have with using the insurance policy as a bank.
So another question came in. What arbitrage should you look for between loan interest and what the policy provides?
So I think what they're saying is like, okay, so the interest right now on policies are between 4 and 5%. Okay. So I'm going to pay, and that's deductible if I'm using it for a business purpose like real estate. Okay. So depending on what tax bracket you're in, maybe it's not really 3 or 4 or 5%. Maybe it's 3 or 4%, right? So I normally try to make at least 12%, 10% with my money that I take out there. And again, now think about this relationship. The money that I'm making inside the insurance policy, once it's in there, I never pay tax on it again, right? So the money I'm earning, I'm not paying tax on. The money that I'm paying to the insurance company to use their money is deductible. How many things in your life have that relationship? Not very many.
Yeah.
So that's kind of the minimum arbitrage. You'll find things, because remember, it's the volume of interest, not the interest rate.
Mm-hmm.
So if I loan the money for an operatory in a dentist's office, kind of the going rate on leases are, 12 to 15% even a year or so ago. And so, but that's say like over 4 or 5 years. So the volume of interest, meaning when a dollar comes in, how much payment, how much is it is interest and how much is principal, is probably 25%, right? So it's not the interest rate, it's the volume. So that's part of the arbitrage, because if you earn $1, Whitney, and you have to give me 25%, that's the arrangement. Do you care what your interest rate is? If I say, but Whitney, you're getting a great interest rate, you say, but wait a minute, no, but I got to pay you 25% of everything I earn. What do I care about interest rate? You shouldn't care about volume.
No, that's a great point. I mean, that also brings up another time that we leveraged our policy to open up a camper van rental business. And so it was, long story short, we had that policy loan paid back off, I think like in under 6 months. And, we were able to go acquire the next asset. It wasn't real estate, but definitely high cash flow, high volumes of cash flow. Now, not for the faint of heart. I'm not saying go open up a camper van rental business. If you don't like hospitality, if you don't want to work day to day with people, don't do it. So,
yeah.
But like you said at the top of the hour, right? People either open businesses or real estate. That's where money is made, and so that's another opportunity there. Just walk us through, like, how does somebody think through of like opening up the policy? Like what dollar amount should they put in there? Like, how should they think about structuring that for their first go around?
Put in what you're comfortable with. And if you're if you were going to go start a business or start a bank, right, and it's going to be profitable, then people typically stretch a little bit, right? But here's the reality. Wherever you start, you're going to grow it. You're going to buy more policies. Just like you're already figuring out, Whitney, like, hey, I need more policies. Because like in that deal that you're talking about, right, in the business that you bought, when the money started to flow back in, what did you do with it? You loaned it out for something else, and then something else, and then something else, and then something else, just like a bank does. They receive our payments for our mortgage, and then they loan it out to somebody else. So they're earning interest from me, from you, from the rest of everybody, just over and over. And you create what we call velocity of money. You get your money moving faster and faster and faster. Movement is a law of God, right? If air doesn't flow in and out of our bodies, we die. If blood doesn't flow through our bodies, we die. If water doesn't flow, it becomes stagnant. And if money doesn't flow, it dies. Okay. So that's why where you should start is the more people understand it, the more money they want to put through it. And I think you're a perfect example of that. As you're learning and seeing it work, you want to put more and more money through it. So that's why I try to educate people in our community with courses and things as much as I can. And we never try to sell you anything. All we're trying to do is educate you, because I know that if I educate you about this, you'll want to buy more and more policies. So I have a repeat customer, just, right? And I'll never ask you for a referral, but everybody gives us tons of referrals once they get it, because they're like, oh my gosh, this is changing the way that we're building our wealth, our financial freedom.
So that kind of dovetails into two questions that I have, opposite directions. One, what about the investor that is worried, or the person that's worried about opening a policy? Is there a maximum that they can put in. We hear, I know in my world, we hear about modified endowment contracts all the time. I'll let you explain what that is. So, so there's that person that's worried about like, what's too much. And then there's the other person that maybe be looking at this and is just like, ooh, what happens if I fall on tough times? Like, what's the flexibility here with this type of banking policy?
Yeah, I love that. I love that question because I just had this happen. I think it was Monday or Tuesday. Today's only Tuesday, right? So it was Monday. Is this a client of ours? He said, we've had a couple changes in our business, in our real estate business. It's not going as well as it was going a year or so ago. And how am I going to put? I think for him, he was putting like $300,000 or $350,000 into his policy because his business was going really well. And the reality was he only had to put like $100,000 in all of the policies together, and he could do that monthly. So when we told him that, he was like, well, I can handle that, no problem. Again, in his landscaping business, his real estate business, he has quite a few things. And so there's a range, but you can also always use the cash value to pay the premium if there's cash value that you don't have loaned out. But I can show you an example of somebody putting money in real estate, and in 4 years, their cash flow back into the policy is more than the policy will hold in 4 years. So this was somebody who actually did this. And so let's say it took you 6 years to get there. Well, once you're 6 years, you're bulletproof because you're not paying the premiums anymore. Somebody else is. That's again when you expand into something else. But there is flexibility in both mode. And this person said, but I'm paying I don't remember what it was, this much per month for the loan. I said, but you're the banker. You don't have to make that loan payment if you don't want to. And that made all the difference in the world. So you don't have to pay back the loan. You could suspend the payments for a while. So if you fall on hard times, I really believe that this makes you way more financially secure than if you didn't have the infinite banking system.
Mm-hmm. Yeah,
you always have access.
Exactly. And, guys, I'm not selling you on a policy here, but I'm just speaking from my own personal experience. Like our premium is like, say 25% of what we're can stuff into the policies. And so for me, I knew if the things got really, really tough, I only had to make that policy premium payment, and that was it. Right. Yeah. I will say, like, I've been through a job layoff, COVID, and now, like, during kind of this choppy waters time, and we've been able to and I'm not trying to extrapolate my situation to other people's, but we've been able to make those premiums and work with our policy holders in order to make sure that we're all paid up on all that. So yeah, they are very flexible. What about I just want to make sure that we're being cognizant of time. Yeah. And everybody, there's tons of other questions here.
What about the MEC? Let me go through the MEC for 30 seconds because I see that in a question. So the MEC is this. Here's the crazy thing about MEC is each insurance company calculates it differently. But wherever they say that line is, wherever they would have to report to the IRS that you put too much in there, and this became a modified endowment contract, not a life insurance contract. They won't just, if you sent in a check that was too much, they won't accept it. They'll send you a letter. This is going to be a MEC. Are you sure you want to do this? And you have to sign it saying you do. But the way that you avoid MEC is you increase the death benefit. So if you have money flowing back into a policy and it's going to MEC the policy, if you let all of that investment flow back into the policy, that's when you need another policy. So the MEC line is tied to the death benefit. So if we increase the death benefit, we move the MEC line and allow for more capacity in the banking system. And remember, it's a system. It's more than one policy eventually.
Mm-hmm. All right, I want to shift gears a little bit, and I
Okay.
know, guys, there's tons of questions here. Jim, we'll touch base with Jim and get his contact information and make sure that you're put in touch with him, and you can get do your follow up and due diligence on this. But something that's near and dear in my heart is, can you open up a life insurance policy on your kids and still access
Absolutely.
cash?
Yeah. So we try to think 3 generations ahead, because my goal is to help you to where your kids never walk into a bank and ask for a loan. And so I would want you to have insurance, and I have insurance on my kids. I have insurance on my grandkids, and eventually someday, hopefully not for a long time, great grandkids. Okay. And I have insurance on business partners. And I have insurance on anyone that I can, in some key employees at my companies. And I'm the owner and the beneficiary of those policies. All they are is the insurer. They have no right to the cash, no right to the death benefit. I have all of that. Now, if an employee was a great employee, could I have a vesting schedule for the death benefit or the cash value? Sure. I can do anything I want because it's non-qualified, which means the government doesn't control it. And it's and so I can control it.
Why would you do that on a key employee?
Well, one, it makes my company more secure. Let's say I have a great salesperson or a great CFO in a company, and I think, if that person gets hit by a bus, that's going to be tough. I mean, I got to go replace that person. And that's one reason. Sometimes it's in a buy-sell situation. If you and I are partners and you say, well, Jim, if something happens to you, your heir is your children or this trust. I don't want to be in business with them. So I'm going to buy you out for a predetermined amount, and I'm going to use my infinite banking policy that I have on you to do it. But then I'd say, Whitney, no problem. You can insure me, but I want to insure you, and you're younger and healthier than I am. So this is going to come out. I mean, I'm going to get more.
I'm going to win.
Yeah.
And that's a very real situation. I had a friend of mine here locally. They, the partners in the engineering firm were set to close the sale, and the senior partner unfortunately had a heart attack and passed. And anyways, those instruments were not in place, and it rather than something transpiring in just a matter of 4 to 12 weeks, it was solid 12 months before the whole sale could be settled. And I know we're talking about money here. There's obviously somebody passed away, right? But these arrangements are supposed to make those decisions easier. That way people can deal with the emotional part of those situations. Jim,
and his family would have got a big check that would have helped them out. So, it's those things don't happen very often, but when they do, you really appreciate having all your ducks in a row.
Mm-hmm. Well, Jim, it's been amazing. I know we have tons of people that want to do some follow-up with you, want to learn more. How can they do so?
Yeah, it's real easy. There's a couple different ways. One is you can go to community.createtailwind.com and join the community. Send me a direct message in there. You can send me an email, jimoliver@createtailwind. And like I said, if you join the community and you send me a message, I'd like to offer you one of 2 books. These books keep flying off the shelf here. There's not a shelf, but sorry about that. You can get my book, Make Bank Without the Bank, okay? Or you can get Nelson's book. And this book doesn't come out till November 14th, but I've got a half a box of pre-release books that I'd be happy to send while supplies last. And if not, we'll send it out to you around November 14th. And yeah, just reach out to me and ask me any question, because I'm passionate about this. Challenge me, question the numbers. I'll send you videos. I'll tell you courses. We can get on a Zoom meeting, whatever. And I don't coordinate all of that. So I know, don't be afraid that I was, 12 minutes late and oh, sure, Jim's going to get on a Zoom meeting. I have people that'll set that up for us, and I promise it won't get messed up, or 90% chance it won't get messed up.
Well, tech works until it doesn't, right? Like we have to be all aware about that. All right, guys, I know there are several of you have private messaged me. Can you put that in the chat box? I'm going to drop in Jim's email right here. Go ahead and quickly snag that. Jim, I just want to say thank you so much for joining us today. I tried to do my best Jim impression before you got here. Obviously, did not work. I'm so thankful to have had you on today. And guys, I'm thankful for you for showing up and learning more about this powerful concept and how it could possibly apply to your situation. Until next
Thank
time.
you guys.
Till next time.